How can you consider your portfolio to be complete without the biggest non-banking financial corporation of India? Hello, folks. My name is Neil, and we are running a series of videos in which, in each video, we pick up one script and we do its fundamentals and technicals. Now, yesterday I realized that the video is becoming too long and I'm speaking too fast to try to keep the video short. So I thought I will split the video into two parts. Part one, we will have all the fundamentals of the script, and then in part two, we will look at the technicals and we'll try to understand what would be the best price for a long-term investor to get in, for a swing trader to get in, and for an intraday trader to get in. That'll keep the video short and it'll allow me to speak in a little more elaborate manner. So today we'll cover Bajaj Finance, which is the biggest non-banking financial corporation of India. Uh, let's get on with it then. Let's go to Screener and Bajaj Finance. All right. So like I said, Bajaj Finance is mainly engaged in the business of lending. It has a diversified lending portfolio across retail, SME, and commercial customers with a significant presence in urban and rural. Basically, it's the biggest NBFC. We'll look at the charts in the part two video. Now, the pros and cons as defined by Screener. The company has delivered a good profit growth of 28.15% CAGR over the last 5 years. The cons, the stock is trading a little high when we look at that in the technical section, and the company has a low interest coverage ratio. Now, the interest coverage ratio essentially means that the company, when the interest ratio is low, it means the company takes more time or has more difficulty in paying the interest on the loan borrowings that it has. A high interest coverage ratio meaning that the company makes a lot of money and is easily able to pay out the interests on the loans and money that it borrows. So a high interest coverage ratio is usually considered to be very good because that means that the company is profitable and has good liquid cash. The peer comparison, as I already said, as far as market cap is concerned, Bajaj Finance is the biggest NBFC in the industry at this point in time. Let's quickly take a look at the profit and loss. Now, um, the net profit is 898 crores in March 2015, which has grown consistently to 4,420 crores in March 2021, which is a dip from the previous year, 5,264 crores. Now, if you look at the balance sheet, and the most important part of the balance sheet, as I always say, is the liabilities and the assets, right? Now, the liabilities in March 2015 was 1,325 crores. And if you look at the liabilities, it has had a healthy growth over the period of time to 2,963. I say healthy growth because the assets have also increased at a much faster pace. If you calculate 1,325 to 2,963 crores is about 2.5% or 2.5 times in the last 6 years. But if you look at the assets, it's grown from 32,780 to 1,71,527, which is about more than 5 times. So the difference between the asset and liabilities has increased. The assets has increased much faster than the liabilities, which is a very, very healthy sign for a company. The cash flows, unfortunately, are not very steady. They've gone up and down. But at this point in time, I mean, if you count March 2020, the cash flows were actually quite good. But then we've seen a dip in March 2021. And you see that pattern in all the companies and in all the ratios from the top to the bottom. Return on equity has been decent, 20%, although in March 2021, the return on equity has been a little low. The shareholding pattern has been excellent. So if you look at the shareholding pattern, the promoters had a 55.14% stake in the company in June 2018. And in March 2021, it has increased to 56.12%, which basically says that the promoters see a bright future and want to increase their stake in the company. Here, the foreign institutional investors have also increased their stake in the company from 20% approximately to about 24%, which is also a very, very healthy sign. The domestic institutional investors have also increased their stake from 8.8% to 9.08%. It went all the way up till 10% at one point in time, but it's then reduced to 9.8, which is also 9.08, which is also not bad. Um, which essentially means that the FIIs and the promoters have picked up their stake from the domestic institutional investors. And then finally, the public, which is the retail investors, it was at 15.64% in June 2018, which has dropped down to 10.57%, which is an excellent sign. It basically means that the promoters, the foreign institutional investors, and the domestic institutional investors are picking up the shares from the retail investors and are increasing their stake in the company, which means that they see a bright future in this company. If you look at the corporate action, this has also been excellent since 2005. We have data since June 29, 2005. They've given out dividend almost every year, sometimes more than once in a year. Actually, most of the times. They've issued rights also multiple times. They've issued splits also multiple times, and they've issued bonuses also multiple times. Now, these are good things for the shareholder because let's say you get bonus on your share. You have, let's say, 10 shares, each share of 10 rupees, which makes your asset base 100 rupees. Now, when the company issues bonus shares, you get 10 shares for free. But then the price of the share is reduced. It's the same with bonuses and splits. The price is reduced. It's the difference is in the face value, but it's not that important. The point is the bonus and splits are more or less same in nature as far as a secondary shareholder is concerned. Now, when you get a bonus or a split, the price of the share reduces by half if it's a one-on-one bonus. But then over a few next few months to years, the share price goes up again. So there's a very high chance that the total asset that you had, or the total capital that you had on that particular share, doubles in the next couple of months. Now, you also see that there are rights issues given. The rights issue was given in June 2013, and then before that, it was given in November 2006. What that essentially means is that the company is offering you shares on what you already hold. So, for example, in this case, it was 6:10. What that means is for every 10 shares that you hold, you are eligible to buy 6 more shares at a discounted rate. Now, the benefit to the shareholder in this case is the shareholder can decide to increase their stake in the company at a discounted rate, which basically means that the average price of their share goes down. Now, they've declared a split and a bonus in September 2016, which means that year was a momentous year for them. And they've not declared a bonus or a split since 2005, which essentially means that there's a very low probability that they'll declare another bonus or a split anytime soon in the next couple of years. But overall, if you look at it, Bajaj Finance is a very good stock to invest in. And, for long-term investors especially, I'm not saying just for long-term investors, but specifically for long-term investors. And what time to get in and what time to get out, what should your targets be and what your entry and exit should be. We'll talk about it in part 2 of this particular video. Please do look forward to it, and I hope you had fun.